I've been interviewed live at the New York Stock Exchange. I've been featured in the media for Forbes and Reuters. I manage millions of dollars for 52 clients. And in today's video, I'm going to show you how Wall Street manages money and why, as a retail investor, your portfolio is still struggling. Specifically, I'm going to show you the 3 secrets that, if you implement today, will lead to a better performing stock portfolio. So the number one secret is buying companies that have a lot of earnings. Now, I know that might seem obvious to you, but how many investors go out and buy a stock solely based off of the stock price? That's not how Wall Street manages money. Smart money, good investors, great investors, they look at the earnings of a company, not the stock price. And so what we're going to do here is we're going to use Ulta Beauty as an example. Ulta, as many of you know, is a makeup retailer, right? Many of us have wives or sisters or girlfriends or mothers who are constantly going to Ulta Beauty to buy new makeup. Now, what you're looking at is just the stock price. That's what the black line is. And what pretty much every regular investor does is they base their buy and sell decisions off of this black line. And then they sit there and scratch their head and say, oh, how come I'm not getting good results? Well, because you're not looking at the company's earnings. Remember, that is the number one secret to better stock market investing. You see, if I plot the earnings on this chart right now we have some context to see if Ulta's stock price at the current moment is a good buy or if it's a bad buy. And what determines that is the price relative to the earnings. So remember, the earnings are the backbone of the company. Peter Lynch, one of the most famous fund managers of all time, famously said, stocks are not lottery tickets. There's a company behind every stock, and if the company does well, the stock will do well. It's not that complicated. And what you can clearly see here is that the stock price, that black line, tracks the company's earnings, the green shaded area, almost flawlessly over the last 20 years. Now, there are times, though, when the stock price is actually above the earnings, meaning that it's overvalued. So, for example, if we take a look here at 2017, the stock price is selling for significantly more than what the company is worth. And what happens when you buy stocks like that? Well, this gap here is called risk. And ultimately what happens is the stock reverts back to what it's worth, and you lose a lot of money. That's what most investors do. We don't want to do that. We want to be the smart investors that buy the stock when it's under its fair value. And this differential is not risk, it's actually margin of safety. And Warren Buffett calls those the 3 most important words in investing. And if we're disciplined and we wait to buy great companies like this at a price that's less than what it's worth, well, then we have an opportunity to make a great return, as you can see here, if we're patient and hold the stock up into its fair value. That's what good investing is. That is secret number 1. You have to buy companies for less than what they're worth. And the way to determine that is you look at the stock price and you compare it to the earnings. Now let's talk about secret number 2 that only Wall Street knows. And it's to buy companies that have lots of cash and no debt. Now, why is that? Well, think about a person. Think about a friend that you might have that has a mortgage, has credit card debt, has auto loan, and no cash in the bank, right? That person is on the verge of bankruptcy. And it's no different for a business. Businesses and people are the same in that regard. So when we're evaluating a stock or a business, we want to find companies that have lots of cash and no debt. Because the risk of bankruptcy when you don't owe anybody any money and you got a ton of cash is what? You guessed it, pretty much 0. So we want to find companies like that because they're safe investments to make. So let's take a look at Williams-Sonoma. If I scroll down here and look at the last 10 years of data, and I look at one very specific line item, which is the cash on the company's balance sheet, which, by the way, these 3 tabs you see here, the income statement, the balance sheet, and the cash flow statement, these are the core of what we call fundamental analysis. So Warren Buffett, Ben Graham, myself, when I manage money for clients, we're all looking at these 3 statements to determine the value and the solvency or the financial health of a business. Now back to the cash line. We can see here that Williams-Sonoma keeps accumulating more and more cash every single year. And again, that's a sign of a very healthy, strong, and powerful business. The same types of businesses that Wall Street owns and knows about, but that the regular investor is oblivious to. Now, if I scroll down a little bit and I highlight another line item, which is the long-term debt, you can see here that Williams-Sonoma essentially has no long-term debt. There were a couple years where they borrowed a little money to finance an expansion, but by and large, the company has no debt. They have been a very disciplined steward of capital, and that's the type of management that you also want to look for when you're evaluating a stock. Good management teams funnel cash into the business and don't borrow money unnecessarily. And if they do, it's for a specific purpose, like you can see here in this example. A couple of years, they borrowed money, financed their expansion, and then they went right back to normal. That is secret number 2, buying businesses with lots of cash and no debt. And the third secret that Wall Street firms know that regular investors don't is to look for companies that have high and growing cash flow from operations. What is cash flow from operations? Well, it's really exactly what it sounds like. As a business, when you are selling a good or service, you are collecting cash for that service. We make a few adjustments on the cash flow statement in terms of how we calculate this line item, but essentially cash flow from operations is measuring how much did you get paid for the stuff that you sold. That's it. And what we want to do is buy companies that are getting paid more and more for selling more and more stuff, right? We want a growing business. I'm using Dick's Sporting Goods as an example because they have a fantastic 20-year history of growing their cash flow from operations. Remember in Secret 2, we talked about the cash from the balance sheet? Well, where do you think it comes from, right? It comes from selling products and services. It comes from the cash flow that you bring in every year or the cash flow from operations. So when you buy a business like this, where every single year they make more and more and more cash, well, then they're going to take all that cash, they're going to invest some of it back in the business, they're going to park some of it on the balance sheet for a rainy day. And because they haven't borrowed a lot of money and they're producing a lot of earnings, we have a business now that's covered on many important fronts. We have a fundamentally sound business, a business that has a durable moat, a durable advantage, and a business which stock price is going to likely continue to accelerate because the value of the underlying business keeps increasing. And that is what we want to do when we're buying stocks. We want to buy stocks that fit this profile. That's what Wall Street does. That's how big money makes more money. It's the same thing that I do for all my clients. I am buying them fundamentally sound businesses that have these characteristics, and that's why the portfolios tend to do very well over long periods of time. There's no short-term secrets in investing. You have to practice patience and discipline, and you have to look for these types of characteristics in your businesses. So just a quick little recap, the 3 secrets that Wall Street firms use to make better stock portfolios is they buy companies that have lots of earnings, that have lots of cash on the balance sheet and no debt, and they got a lot of cash flow coming in from their operations. If you are losing money in the stock market or you simply just want a better stock portfolio, shoot me an email, Raul@DocShahFinancial.com. I'd love to hear from you and your personal situation and how I can help. I manage millions for 52 clients at the time of this video, and I'd love to hear from my YouTube subscribers. So go ahead and reach out and I'll get right back to you. Thanks for watching. Remember, like, comment, and subscribe, and I'll see you in the next video.